Well, good Friday to you. I hope you guys have had a good week. I hope you're having a weekend ahead that's going to be full of joy and peace with your family and friends. So I come to you today kind of empty-handed. I really don't know what to say. I've read a lot of information. I've studied the charts. I've read pundits' opinions. I've got a lot of people that I follow in the markets as well, and they are all shaking their head a little bit. We had a week where we thought that we would see some positive data that would impact our bonds, which impact our mortgage rates. And we did. We saw exactly what we thought we would see. The CPI report came out, showed that inflation is getting better, markedly better, in fact. Now, if you want to peel back the onion, used car prices are showing a rise again, and that played a little negative effect in the inflation numbers. But the core numbers look really good. The Feds met this week, as you probably are aware, and they have mentioned that, of course, we knew that we didn't think they were going to raise rates, and they did not raise rates. But the problem wasn't in the fact that they didn't raise rates this week in terms of the Fed fund rate. It's that they are talking about the need to continue to raise rates in the future, despite the fact that inflation is getting better, despite the fact that we see all sorts of signs in the job market, despite what you may see or read in the media, the job reports are showing that there are more jobless claims week over week over week, and lots of data indicating that we are already in the throes of a recession that we're not really feeling right now, but a recession is definitely looming. And something that nobody's talking about in the media is the fact that the 2-year and the 10-year Treasury is inverted. Not just inverted by a little bit, but inverted by a lot. And it's been inverted for a long time, and there's no end in sight to right the ship with that. And I've talked to a lot of people over this past week about that, because some people are asking about 3-in-1 ARM, 5-in-1 ARMs, when your 30-year fixed rate mortgage is better than a 5-year rate, something's wrong. But all of those things typically indicate a recession is looming. And the problem with what we see and what the Feds are talking about doing is that they continue to utilize this, the analogy that I've used, several weeks ago, where if you got a headache, you take a couple of Tylenol, and you wait 30 seconds, you still have a headache, you take another couple of Tylenol, and then 10 seconds later, you take another, and you continue to take as if you don't give it time to work. And that's essentially what we feel like they're doing when they're talking about forward rate hikes, despite the fact that the inflation is already getting better. The headache is starting to subside, but they feel like they have to continue to stick that knife in that chest, continue doing that to continue the bleeding. And I think what's going to end up happening, and this is just my opinion, I've not heard this by anybody saying this, but I think it might come up in some forward remarks in the economist minds, is that we're going to see some deflation that's going to end up happening on the other side of that, which can actually have even more of a negative effect. You don't want deflation either. And I think we're going to have some issues because they're overcompensating. So what does that mean for mortgage rates? This week's been very volatile. Rates were better some days. I think we've seen basically flat. I mean, you're going to see the rates that we're posting to you today. They're going to be basically flat, a little bit better. But as I'm posting this video, as we speak, it's pre-market. The markets haven't opened yet, and we're seeing a lot of volatility before the market. So honestly, I don't know. Someone asked me earlier in the week, said, "Can you give me a rate sheet?" And I kind of laughed. I didn't laugh in their face, but they just didn't realize that rates change so much. I mean, what I can tell you what rates are doing right now, they're going to be different at 10 o'clock this morning. They're going to be different at 3 o'clock this afternoon. They're certainly going to be different by Monday. So we have to be careful in understanding that sometimes it's a snapshot, but it's not really a snapshot. I mean, it's a snapshot of a video that's happening. It's fluid, and it's happening constantly. It's very volatile. So we got to be patient. Rates are still not where we want them to be. But again, long term, they are going to get better, and we know that. And so again, just be vigilant, be patient, talk to your clients about the ever-growing housing market that's continuing to be strong, especially in our markets. And, I think as long as they understand that, buying a house right now, we have to understand maybe we can buy some points, maybe we don't, maybe you start looking at the temporary buy downs again. That's something that was very, popular about a year ago. I think it's something that we should talk about. But everybody's situation is different. It's not cookie cutter. So let them talk to a mortgage specialist. Let us help them in their situation. I want to see what their whole plan is, not just for buying a house right now, but what are they looking at doing in the next 3, 5 years, 10 years, 15 years? What's their dreams? And let's set that up for success. And so we will talk to people. I've written probably a dozen loans this past week, and they're all different because everybody's situation is different. So let's remember that, and let's work the relationship and not just transactions. And so let us talk to your clients. Let us help them in their plans. And y'all have a great weekend, and cross our fingers that next week we'll continue to see improvement in rates. Y'all have a good one.